my name is Nurul Dahlia Shamimi binti Zulkifli and my metric number is 304722. Today we will be presenting our analysis and recommendation for Innova Craft Textile Textile Berhad, which is a smart textile, smart and eco-friendly home textile company. Their flagship product is Confisense bedding, which is combined comfort with sustainability using recycled and organic materials. The company distributes its product online and through independent sales agents. In 2024, Innova Craft sold 100,000 units, generating RM 2.5 million in revenue. The main objective of this project is to apply cost-volume profit, which is a CVP analysis, to help management evaluate their current cost structure and profitability. We will also provide strategy and recommendation to improve performance in 2025 and assess how change in cost and sale volume may impact the company profit under different business scenarios.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Fatimah binti Nur Hishan and my metric number is 304646. For the first part, we were required to reproduce the income statement of Innova Craft Textile Sdn Berhad for the year end 31st December 2024 using a simplified CVP format. Based on the data given, the company total sale revenue is RM2,500,000. The total variable cost include variable production cost of RM1,250,000 and sale commission of RM300,000 and bring the total variable cost to RM1,550,000. After deducting variable cost from sale, we get a contribution margin of RM950,000. The fixed cost consists of various expenses such as fixed manufacturing overhead, digital marketing, factory rental, administrative salary and utilities and insurance, with a total of RM540,000. Finally, after subtracting all fixed costs, the company record a net operating income of RM410,000. Now, we move on to the key calculation and formulas for Part A, Question 2. A. The company maximum production capacity in 300,000 units. So, to find the sale price per unit, we divide total sales by total unit produced. That is RM2,500,000 divided by 100,000. The result is RM25 per unit. B. We already calculate the total variable cost earlier. Is the sum of variable production cost and sales commission. 1,250,000 plus 300,000 equals RM1,550,000. C. To get the variable cost per unit, we divide the variable cost by total units. 1,550,000 divided by 100,000 equals RM50.50 per unit. D. The ratio of variable cost to selling price per unit is total variable cost divided by total sale revenue. This is RM1,550,000 divided by RM2,500,000. This gives us 0.62 or 62%. E. The total fixed cost is the sum of all fixed expense. 240,000 plus 70,000 plus 20,000 plus 60,000 plus 120,000 plus 30,000. This gives us a total of RM540,000. F. To find the contribution margin per unit, we subtract the variable cost per unit from the sale price per unit. RM25 minus RM15.50 equals RM9.50. G. The contribution margin ratio is the contribution margin divided by sales revenue. So we take RM950,000 divided by RM2,500,000. The result is 0.38 or 38%. H. The break-even point is unique in calculate by dividing the total fixed cost by the contribution margin per unit. 540,000 divided by RM9.50 equals approximately 56,800 BKANK1013 units. I. The break-even point in ringgit total fixed cost divided by contribution margin ratio. So we take 540,000 ringgit divided by 0.38. This gives us 1,421,052 ringgit and 63 cents. Lastly, the net income to sale ratio is calculated by dividing the total income by total sale. That's 410,000 divided by 2,500,000. The result is 0.164 or 16.4%.
Assalamualaikum and hi. My name is Nur Aina Bila binti Omar. My matric number is 304848. So, CVP analysis is an important tool for managers to plan profits. For InnovaCraft, we analyze two possible strategies to reach their target of a 28% net income to sales ratio in 2025. For scenario 1, we focus on how many units InnovaCraft needs to sell if they want to maintain their current selling price but face an increase in production cost. For selling price per unit, we get RM25 and new variable cost per unit 12.50 cent ringgit plus with 4% equal to 13 ringgit, and contribution margin a unit 25 ringgit minus with 13 ringgit equal to 12 ringgit. Contribution margin ratio we get 48 ringgit. We first calculated the contribution margin, which is 12 ringgit per unit. Then, using the CVP formula, we determine that InnovaCraft needs to achieve total sales of 3 million ringgit. This means they must sell 1020k units in 2025. For target sales revenue, we get 300,000. Target quantity to sell, we get 120k. To meet the 28% profit target, InnovaCraft must increase sales by 20% or 20,000 more units. However, with competition and weaker market demand, this may not be easy to achieve. Next, we move to for scenario 2. We focus on adjusting the selling price instead of increasing units, assuming the company can only sell 100,000 units next year. So for formula used, P is required selling price per unit. So we get 26.39 ringgit per unit. So next for contribution margin or unit, we get 26.39 ringgit minus with 13 ringgit equal to 13.39 ringgit. For contribution margin unit, we get 26.39 ringgit minus with 13 ringgit equal to 13.39 ringgit. And for contribution margin ratio, we get 50.7%. By using the CVP equation, we found that the new selling price required is 26.39 per unit, about 1.39 higher than the current price of 25 ringgit. While this price increase can help InnovaCraft reach their profit target, it also introduces risk. Customers might turn to competitors if they feel the price is too high. We recommend balancing price with attractive promotions and marketing the eco-friendly value of the product. Lastly, for scenario 1 and scenario 2, our recommendation is to use a combined strategy, which is try to grow sales moderately while also making small justified price increase support by marketing. This way, InnovaCraft can reach its goal without risking too much customer loss. That's all for me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh and a very good day. My name is Noarina binti Rohaizat and my matric number is 304572. I will continue the presentation with scenario 3, marketing strategy and cost efficiency improvement for InnovaCraft Textile. In this scenario, the company aims to overcome the increase in raw material prices by enhancing marketing and promotions as well as improving operational efficiency. To achieve this goal, the selling price is set at 28 ringgit per unit. The sales commission will be increased to 16% of total sales. Digital marketing costs will increase while other fixed costs are reduced by 30%. Sales are expected to increase by 100% from 100,000 units to 200,000 units. Therefore, we need to calculate the net incomes to sales ratio for this initiative. First, we calculate the total sales revenue. To calculate this, the selling price per unit is multiplied by the unit sold. So, 28 ringgit multiplied by 200,000 units and total sales revenue equals 5,600,000 ringgit. The second step is to calculate the total variable cost. The variable cost per unit increased from 12 ringgit 50 cent in 2024 to 13 ringgit in 2025 due to a 4% increase in cost. The variable production cost is calculated as 200,000 unit multiplied by 13 ringgit, which equals 2,600,000 ringgit. Next, the sales commission is 60% multiplied by the total sales of 5,600,000 ringgit, which equals 896,000 ringgit. Therefore, the total variable costs are the sum of 2,600,000 ringgit plus 896,000 ringgit, which is 3,496,000 ringgit. Next, we calculate the new total fixed cost. The fixed cost in 2024 was 540,000 ringgit. After a 30% reduction, the fixed cost in 2025 is 540,000 ringgit multiplied by 70%, which equals 378,000 ringgit. Then we proceed to calculate the net profit. To calculate net profit, we take the total sales revenue minus total variable cost minus fixed cost. So 5,600,000 ringgit minus 3,496,000 ringgit minus 378,000 ringgit and net profit equals 1,726,000 ringgit. Lastly, we'll calculate the net income to sales ratio as required in this scenario. The formula is net profit divided by total sales, then multiplied by 100. So, 1,726,000 ringgit divided by 5,600,000 ringgit multiplied by 100. The result is 30.82%. In conclusion, this strategy successfully exceeds the company's 2025 profitability target of 28%. The company is able to achieve a net income to sales ratio of 30.82%, which indicates a significant improvement in performance as a result of aggressive marketing strategies and reduced fixed costs.
I will explain about scenario 4, which is its product enhancement plan. Innova Crafts still plan to upgrade its confidence bedding with smart home integration. The plan will first is increase COGS, which is variable to sale ratio to 57%, inclusive of the 4% raw material price increase. So second is increase digital marketing expense by 13%. And third is expected to boost sale with volume by 115%. So evaluate whether this plan will help the company meet or exceed its 2025 target. So what should I do first is I calculate the new sale volume and sale revenue. So in previous unit sold in 2024, previous year which is 100,000 units and price per unit is RM25. So the new sale volume in 2025, 100,000 unit, multi 2.5, which is 115% increase. So we can get RM215,000 units. So for the sale revenue for in 2025, 215,000 units, multi RM225 ringgit. So we can get RM6,215,000. Which is we get RM6,215,000. So second, I calculate the new variable cost, which is COGS. So COGS, which is 57% of sale revenue. So 57% multi RM6,215,000. So we can get RM3,562,000,000. So third, I calculate the feed cost. So from 2024 fixed cost, which is feed manufacturing overhead, which is 240,000, and digital marketing is 17,000. So I increased by 30%. So 17,000 multi 1.3, which is still 30%. So I get 19 1,000. So website maintenance, we have 20,000, and factory rental 60,000, and administrative salary is 120,000, and utilities and insurance is 13,000. So total fixed cost in 2025 is feed manufacturing overhead plus digital marketing plus website maintenance plus factory rental plus administrative service plus utilities and insurance. So we get 561,000. So fourth is calculate contribution margin and net profit. Contribution margin, which is sale revenue minus variable cost. Sale revenue, which is 6,215,000, and variable cost is 3,562,000. So sale revenue minus variable cost. So we get 2,687,500. So next is net profit. Net profit is contribution margin minus fixed cost. Contribution margin is 6,087,500 minus 561,000. So we get 2,126,500. So fifth is calculate net income to sale ratio. Ratio, which is net income divide sale revenue multi 100. So net income is 2,126,500. So we divide which is sale revenue of 6 million 215,000. So we multi, which is 100. So we get 37.025, or we call it is 34%. So this product plan leads to a net income to sale ratio of 34%, which is exceed the company target of 28%. So this plan is financially beneficial despite higher costs, because the significant increase the sale volume contribute to a much higher overall profit. So thank you.
Assalamualaikum and good day everyone. My name is Intan Nabila and my metric number 304852. Now, let's take a look into scenario 5, where Innova Craft Textile is considering two possible strategies to restructure its sales force in the year 2025. In option A, the company will increase the current sale commission from 12% to 18% to motivate agents. As a result, sales volume is expected to increase by 50%, bringing total sales from 100,000 to 150,000 units. The selling price per unit remains at 25 ringgit, so total sale will be 3,750,000 ringgit. With the raw material cost is increasing by 4%, the new variable cost per unit becomes 13 ringgit, giving a total variable cost of 1,950,000 ringgit. The commission expense at 18% of total sale is 675,000 ringgit, and fixed costs remain unchanged at 370,000 ringgit. After all deduction, the net profit under option A is 755,000 ringgit. Now, let's take a look at option B, where the company will hire a full-time sales representative. Each staff members earn 1,700 ringgit per month, which total 163,002 ringgit per year for all 8. They will also receive a 4% commission on sale. With this approach, sales volume is expected to increase by 70%, reaching 170,000 units. Total sale will be 4,250,000 ringgit, and variable costs become 2,210,000 ringgit. The commission is 170,000 ringgit and salaries total 163,200 ringgit, making total selling cost 333,200 ringgit. Fixed costs remain the same at 370,000 ringgit. The resulting net profit under option B is 1,336,800 ringgit. Here's a summary of both options. This is criteria option A and option B. So based on our analysis, option B is clearly the better strategies. It delivers a significantly higher net profit, higher by 581,800 ringgit. It is also more cost-effective, provide greater control over the sales force, and is scalable for future growth. Therefore, we recommend option B, hire in-house sales representative as the preferred solution for InnovaCraft in the year 2025. That's all from me. Thank you.